Ladies and gentlemen, welcome to the Cadence Capital Limited webcast for March 2012. The fund was up 11% for the financial year to date at the end of March 2012, I beg your pardon, against a stock market which is down slightly for the All Ordinaries Accumulation Index and down more than that for the Small Ordinaries Accumulation. So that we've outperformed the All Ordinaries by about 12% and the Small Ordinaries by about 10 and a bit percent. Fortunately for the period, we've been rated the number one performing listed investment company again in Australia over 1, 3 and 5 years. Turning briefly now to the specific stock performance within the portfolio for the quarter. The stocks that have performed well for us include RHG Limited, Macmillan Shakespeare Limited, VDM Group Limited, Flexi Group and the ANZ Bank. Underperformance has come from Reckon Limited during the March quarter, and I'd like to just talk specifically about that. Reckon announced during this quarter that it had renegotiated its terms with Intuit, the parent of the Reckon software, and that they would no longer be paying a royalty for the software and would be entitled to the latest version of the software and then no updates from then on, which means that Reckon will be responsible for developing their own software from then forward. But they are able to use the existing software product for the next 100 years. The market has viewed this with some uncertainty initially, but I think as people begin to understand the renegotiation of this contract, it will be seen as a positive for Reckon in that they can brand all of their product the Reckon brand, and in addition it opens the company up for potential corporate action, consolidation, mergers and acquisitions, or additional activity within the sector, which we think in the medium to long term will be viewed as a positive. The March quarter has also been quite an active period for our outstanding options. The options trade on the stock exchange under the code CDMO, and each shareholder was given a bonus option issue. Last September, there were roughly 27.6 million options issued, and we have had 9 million of those options exercised to date, a large portion of them exercised in the first quarter of 2012, so that shareholders could receive the half-yearly dividend of 4.5 cents. That means there are 18 million outstanding options, and should those options be exercised by their due date, the 15th of September 2012, Board and management have indicated that the options that get exercised before that date will be entitled to the full year dividend. Turning now to the curious underperformance of the Australian equities market against the rest of the world. The first slide that we have presented here shows the Australian All Ordinaries Accumulation Index being down roughly 30% since its high just before the global financial crisis. The German index and UK indexes, which are shown in this diagram, are only down 10% since the global financial crisis, indicating that there's been significant outperformance by these indices, despite the fact that those countries live within the Eurozone, which at the moment is experiencing significant political uncertainty and a lot of economic uncertainty as well. The picture for the US stock market is even more pronounced in the following slide. Again, the Australian stock market is down around 30% since the peak in before the global financial crisis, and the American market looks to just about be making new highs at some time this year, which means that it has totally recovered from the consequences of the global financial crisis, at least in terms of equity prices. Now, that against a backdrop of a country that has been in very, very difficult economic circumstances relative to Australia once again. So what does it all mean? Here we've shown a few indices in very, very difficult economic and political circumstances in different parts of the world, and many people will have read newspaper articles, business journals, or been watching the news or interviews with many very, very experienced commentators indicating that these are regions that are in great difficulty, whereas Australia, in theory, has a very, very good economy and has been performing well. We've had many, many years of property booms, an economic boom in relation to resources, and certainly since 1986, a big boom in the superannuation industry. And yet, our equities market has significantly underperformed these other markets. Now, commentators immediately point to the fact that if you adjust for the appreciation of the Australian dollar when comparing these indices, then the numbers look a lot better. And certainly they do. But that doesn't help an Australian investor who has been invested in Australia in Australian dollars. And even taking that into consideration on the next chart, you can see that the US market has outperformed the Australian market more recently, even adjusting for the difference in the two currencies. What does this mean for the longer term? Well, is this just an incongruous situation that will continue over time? Or will the Australian equities market recover to the extent that the American and European markets have? Well, one way that this may happen is that if interest rates were to fall in Australia and the Australian dollar was to depreciate somewhat in value, then our equities market would in effect get a kicker. Exporters would be earning more dollars. It would reduce the amount of importing that's taking place into Australia, and from a global perspective would make some of our assets look significantly cheaper as well. So I think it's fair to say, on the one hand, that the Australian equities market has been crippled and struggling under the strength and continued strength of the Australian dollar. But were the Australian dollar to come off or weaken a little bit, that would certainly assist the cause or the case for an improved Australian equities market. So where does this macroeconomic view and this macroeconomic, in effect, observations assist us? Well, in many ways they do, and in many ways they don't. It's very difficult for us, sitting down here in Sydney, Australia, to try and predict what the macroeconomic environment globally is going to look like 3 or 6 months from now. But what it does assist us to do is to look into particular situations or particular companies that may be of interest. We may be able to look at stocks that will benefit from a lower currency and from lower interest rates. We could look for good value and good opportunities in stocks that would benefit from lower currencies. For example, exporters will benefit. Importers potentially won't benefit in this environment. And once again, we have to reiterate that it's the bottom-up stock-by-stock analysis combined with our detailed and disciplined manner for entering and exiting positions that will work for the fund again. We're pleased to say that this approach has worked for the fund for the last 9 months and specifically in the last quarter, and the fund is up 11% for that period against all ordinaries and small ordinaries accumulation index that are both down. We will continue to look for bottom-up opportunities and stock-by-stock selection opportunities and enter and exit those positions in a detailed fashion. Ladies and gentlemen, as always with these quarterly webcasts, we'd like to take this opportunity to thank our investors for their continued support, and also to encourage investors to get in contact with us either via our webpage or email addresses on the webpage, or via the telephone numbers that are displayed on the webpage. If you have any additional comments you would like to make, or if you have any questions in relation to the fund, please do not hesitate to contact us. Thanks very much.